Hello, I'm Working Dad Trader, and today I'm going to do something completely different in this video. I could have done so many videos this week with so much going on. As we're all aware, what's been happening in the market, there's been a downturn, there's been a drop, there's been all sorts of headlines of crashes and recessions, and lots of things going on with panics and all these different things in the media. So we're all fully aware, if we've been following the news and aware of what's happened with the S&P 500 and people's stocks and portfolios. And I could do all sorts of channels about let's go and get after these stocks. The stocks are on discount, etc., etc. But this channel, when I made it, is about one, like myself, it's about working class people. It's about people who have children, who have family. It's about parents. It's about, like say, working class people. It's about just normal people that are struggling every day to power through and to do something better and get their finances sorted and hopefully make a lot better life for themselves. And there is no quick fix, and it takes patience, and it takes a lot of hard work and struggle. And this is why I've done this video today. I mean, we've all seen it all out there. Everyone's shouting, come on, buy the dip, buy the dips. All these big companies are on sale. It's time to make money. You keep seeing all the stuff from quotes from Warren Buffett saying, you know, be fearful when others are greedy and greedy when others are fearful. And this is the time now why people are panicking and selling to go and get these stocks. And yes, I agree, that is great if you've got the money. If you've got money saved by for this event where the stock market has pulled back, then great, go and invest sensibly in good companies or in ETFs or index funds. It's a great time to buy sensible companies, like especially at the minute, like the tech sector, which has dropped off. There's a lot of great tech sector companies like Google, Facebook, etc. that are quite cheap at the moment. But if you don't have the money, this is not a great time to get involved. Like myself, you might have a family, you might be on a tight budget, you're working every month, you've got bills to pay, you've got a mortgage, etc. Things are tight, so you only have a regular amount every month that you set up to invest, which is fantastic, which is way better than most people out there do. You've got control of your finances and you're investing a little bit every month. Like myself, this is exactly what I do. Into investment vehicles for your long-term future. Now, I invest on a regular monthly installments, roughly around £250 a month, and that includes my own personal investing ISA and my children's junior ISAs. That's how much roughly I spend every month. It goes every month, it invests into these vehicles. Other people might be investing less, £100 a month, etc. It's all great. You're making great steps to your future and for your retirement, etc. This is brilliant. It's way better than what other people are doing. Lots of people are on tight budgets, and when you're like myself, you're working class, you've got families, you're struggling, don't feel FOMO. There's a massive thing out there, especially with social media, that you feel that you fear that you're missing out on a fantastic opportunity. You have to ignore this opportunity. If you don't have the money and you just got this budget plan, stick to the budget plan. And I'm going to go through why in a moment. Okay, so what you don't want to do now, and this is really important, is to borrow money at this opportunity. All the hard work that you guys have put in to sort out your finances, get rid of your debt, get yourself on a really strong financial footing, and you're investing regularly, monthly for your futures. Now is not a time to panic and think, well, I'm going to miss this opportunity and borrow money, taking on lots of debt, or some trading accounts will let you leverage lots of money on trades, and you think, this is a great opportunity, I'm going to have to do this. It's so risky, guys. It really is really, really risky, and I do not recommend this whatsoever. Yes, you might borrow the money or leverage the money, and it could be right, and you got a chance of coming off, but it is a form of gambling. How do you know where the bottom is? I don't know where the bottom is. Next week the market could drop even further. If we look at the S&P 500 at the minute, it's only actually dropped 4% from its high, which is not massive. 4% is very little in the grand scheme of things. It could drop still 10%, 15% yet, and that's still a normal thing that happens in the stock market. So 4% in the drop of the S&P 500 is nothing, and it always goes back up again. But like I say, no one knows where the bottom is. If you leverage lots of money on a stock, for example, or just the S&P 500, or you might say, oh, I'm going to go and invest all my money on Google or wherever it is. I mean, the chances are that the stock will always go up, but in the short term, that stock could still go down. It could go down further. You really don't know where the bottom is. So it's really, really risky. And it's, like I say, it's a form of gambling to start messing around with borrowing money and leveraging your position. It's really, really quite high risk. So I do not in any way recommend this way of investing. I say stick to your investing plan every month. It's the safest way, and it's long term. In 10, 15, 20 years, 30 years time, you will be really, really happy and really well off, and you'll see some great results. Okay, and to help put your minds at rest, I wanted to show you some charts to just basically so that you don't get crazy and you just calm down. On this chart, it's a 30-year chart from 1990, and it just looks at the difference of buying the dip and which we call dollar cost averaging, which is just monthly installments. Like myself, that comes from my bank and goes into an investment vehicle, whatever your choosing is, or you buy stocks every month. It's just the same amount every single month, which is what I do myself. So that is what is called dollar cost averaging. So every month it just buys at whatever the price is at that moment in time. So some months it could be lower, and other months it can be higher, but over a year it sort of balances itself out, and over the long term it just balances itself out. You will buy dips and you will buy highs and lows, etc. That's just what dollar cost averaging is. So this compares if dollar cost averaging to buying a dip, and it's done on a basic principle of if you use the same amount of money, which was you just put in $2 for dollar cost averaging, and you put in $1 every day on buying a dip, and every time the S&P 500 dropped more than 2%, then you spent another $1 on that 2% dip. And really interestingly, after the 30 years difference, as you can see in the chart, there's very, very little difference in the return from two different methods. And in fact, on just the same amount of money, on this one, the actual dollar cost averaging is just very, very small, very slightly ahead of trying to buy the dip every time the S&P 500 drops more than 2%. So that should keep, that's something good to keep in mind, and just, to look at actual stats. Okay, and to look at chart 2, and don't get me wrong, I'm not saying buying the dip in certain situations is not a bad idea. If you've got cash spare in savings, that you can afford to put into the stock market, then this is a good opportunity to buy good companies. If you invest it in good companies, yes, you can make some money. And if we look at chart 2, it's very similar to the first chart that I showed you. The difference is, but this time with dollar cost averaging, we only invest $1 a day for the 30 years. Whereas in this scenario, if we do buying the dip, we invest $1 a day, and then we also invest another $1 every time the S&P 500 dips more than 2%. So on this scenario, you can see that obviously buying the dip did come out slightly ahead. Okay, so I've talked about these further charts in previous videos. Historically, if we look at the chart, September is always historically a bad month for the stock market. It is generally always down at this time of year. And once we get to November, December, they're really quite historically strong months, and we will see a rally. Generally, what happens historically at the end of this year. So keep that in mind. And I've also showed this other chart before, which talks about, this chart shows the annual returns from the S&P 500. If that's all you invested in was the S&P 500. This chart goes back to 1928. And since 1928, 67% of the years since 1928 have been positive. So the S&P 500 has finished it positive, and so it's made money. And only 25% of the time the S&P 500 has finished a negative in losing money for the whole year. So keep that in mind, that if you're invested in the stock market over a long period of time, 67% of the time, it's making money. Now, like I said in other videos, if you were going into making a bet or whatever, and it was guaranteed 67% of the time that you were going to make money from that situation, you would do it day in, day out. So it's a fantastic way of making money. So you just need to keep calm and be patient. Okay, so thank you very much for watching. I hope you've gained something from this and it's helped you feel better about the situation. Like I say, don't give in to fear of missing out on an opportunity. Just stay calm. And like I started the video on a quote from the famous Warren Buffett, let's finish on a quote also from Warren Buffett. And that quote is, "Successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time." And that is very important. There's no quick race to being financially free or having a great financial future. It does take lots of time, discipline, and patience. And this is for you guys. And like I say, you take care out there and be sensible with your investing. And I hope to see you soon.